Okay, good afternoon, dear traders. Let me know if you can hear me well. Okay, sound is clear. Okay. On behalf of IFC Markets, I will welcome you to the webinar Currency Indices, Natural Trading Approach. Thank you again, FX Street, for this nice opportunity for discussion. Okay, how can I move on? Okay. Here you can find some brief information about me and the supplementary articles that may arouse your interest. First of all, I would like to ask if some of you apply currency indices in your trading practices. Do you? Just give us a sign. If you did, then this webinar should be even more exciting. Please feel free to ask me any questions during the presentation. It will be more comfortable for everyone. So this webinar gives a short description of trading approach based on portfolio currency indexes. I would like to remark that a suggested strategy is based exclusively on technical analysis basis. It means that no fundamentals are involved directly and no subjective elements are used. So, just a second, I have a question. I don't understand what is indexes. Okay, I will show you in the next slide what is it, what the structure of the indexes. Okay, just start from the beginning. What is the basic rule of technical approach introduced by Mr. Charles Dow? You can see his photo here. So-called Dow theory. Exactly, market price discounts all fundamental information immediately. It means that efficient market hypothesis, so-called EMH model, is implicitly taken into account by Dow theory. So we can say that random Brownian motion of price occurs in this case. Indeed, EMH followers state that it is impossible to beat the market because a fair price is formed immediately. So it is not impossible to beat the market according to EMH, and that's why buying the rumors, selling the facts is impossible. That's the theory. But in statistical terms, they are completely right. Only 5% of FX traders are profitable by the end of the year. At the same time, we have another dual rule: inertial trends exist. It means that the long-term memory exists as well, right? Is it a contradiction? Absolutely. There are stages of evolution when the market practically neglects all the fundamentals and continues to process previous significant data. In such a way, we have the reaction delay. We're speaking about the so-called long-term memory. Dow theory is contradictive, and then in the considered case, the current price is not enough. As price doesn't discount all the data, we need more information out of single price approach. One way is an explicit fundamental analysis. Another, introducing fundamental indicators which react to significant fundamentals. Besides, what about net effects when the cross-market interaction occurs? It is not taken into account as well by Dow. However, strong fundamentals shock different markets at different extents simultaneously. The panic sale of euro may cause net strengthening of USD. As a result, suddenly USD-GPY pair comes to the green zone. It becomes possible because of arbitrage trading and cross-market correlation. The strongest fundamental releases have a cumulative net behavior, but at the same time, they process by custom one instrument technical analysis. It's a paradox. So, what is the shortest path to widen the horizon without loss of simplicity? Composition of market indexes is one of the possible solutions. So, a currency index is an instrument which is used to show a motion of considered currency in relation to overall FX market. Most liquid instruments should be taken into account. A basic currency is considered again its major counterparts, for example, euro against franc, yuan, USD, and British pound simultaneously. Currency index has obvious analytical advantage. It clearly shows tendencies in a single economic zone, Eurozone for euro index, for example. The principal role of a currency index is its objectivity. Its reaction to fundamentals of other currency zones should be minimal. According to the data of Bank for International Settlement, you can hear it, a monthly turnover of central banks has shown 7 currency leaders. You can see them right there. Let's move on to our basic question, the algorithm of index composition. So the first way is a traditional USD index, which is traded in ICE. However, the problem is that this index has a nonlinear structure. A small fluctuation of some component, for example, this one, leads to unproportional growth of index value. It's a very convenient way of composition for trading, but it has a lack of objective fundamental value because it gives a distorted picture. Another way is portfolio approach. So here we represent possible schemes of Euro index and USD index portfolio construction. We preserve simplicity by using equal units, €1 against the portfolio of $1, 1 yen, and so on. You may see that each index is based on the relation of the basic currency and FX benchmark. So here is the benchmark. Although some brokerage companies and banks provide currency indexes, they cannot be modified and used in a personal trading system. These indexes, which are represented here, are just the exceptions. Our goal is to include network market data in a classical trading approach by the use of these very indexes. So for this purpose, one of the intelligent trading platforms has been used. NetTradex option creates a personal component instrument, allows us to create a personal trading instrument based on elementary assets. I don't know where you can see all the details, but I hope that you can. So indexes are composed via the PCI interface inside the NetTradex platform. We have no intention to trade them. That's why the trading volume may be defined in an arbitrary way. But here I have selected 1 unit of euro against 1 unit of Canadian dollar and so on. The benchmark is built by adding the necessary currencies in the quoted part of the table here. And this is the basic currency, the quoted currencies. EURi and vsUSDi represent Euro index and reverse USD index correspondingly. Here I have shown the interface of Euro index only. In the represented figure, Euro is placed in the basic part, first table, here, while a benchmark portfolio is expressed by the quoted assets, second table. As a result, a new instrument can be added to the platform library. Open-close index prices are calculated automatically on the basis of relation between the basic part, this one, and the quoted part, this one. So only candle borders are displayed in the platform. Now we have 2 indexes which express the fundamentals of 2 currency zones. Euro index here, vsUSD index, which is the reverse to USD index, and EURi daily time frame here. Let's apply the supplementary instruments to filter signals of EURi currency pair. Now we have 3 charts composed in NetTradex: EURi, Euro index, and reverse USD index. Daily time frame is selected, however, you may experiment with other time frames as well. Please note that the platform can only form open-close prices for synthetic instruments like indexes in PCI interface. However, all the history is available for traditional instruments. So we have open high-low close prices for EURi and open close for the indexes. There is a well-known timescale approach when you consider the given market at 2 time frames or even 3 time frames. That is so-called system of Alexander Elder. This system is merely a modification. We make space extension instead of time extension to filter signals. Here we consider a fragment of daily chart. It is composed by 3 stages of market evolution: flat, trend, and again flat. A conservative trading idea is very simple. Your USD position should be open if both parabolics here, give bullish or bearish signals simultaneously. It means that EURi index strengthening and USD index weakening should be synchronized, the net market effect we are looking for. If one of them is reversed, then we should leave the market and close the position immediately. I have highlighted the corresponding regions where the position should be held by green color, here, 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 and here, the so-called trend regions. If contradictory signals are received, the region is considered as a mean reversal stage, red regions, here and here. It should be noticed that the considered system can be used simply as an indicator of trend for flight reversion. So you can combine it with supplementary approaches. You can see that the first breakout here is correct, and our system gives a buy signal immediately here. Note that we completely ignore the parabolic of the price chart, these values. However, I placed it here for illustration purpose only. You should open close position at the close price of the current candle when the next parabolic point is formed. Note that the first reversal signal of price parabolic, the first reversal here. I wonder if you can see it, but one point is above the price chart here. So the first reversal signal of price parabolic is not confirmed by our strategy. We continue holding the position, so the green region. At the same time, we exit the market exactly at the right time, here, the top. So we have a false breakout of the support level, this false breakout, but it is ignored again. We enter a position only when a correct breakout occurs. So we enter the position here. What I suggest is to enter the market at the close level of two signals of indexes, or when two signals of indexes are synchronized, and to leave the market at the close level if the synchronization is interrupted. It is very simple system. The charm of this approach is that we use analytical power of indexes, but we don't load our deposit by expensive portfolios. So the filtering properties of portfolio indexes are preserved, but we still used it only one instrument. The motto of this trading approach is trend is short, make the most of it. Okay. That's the trading strategy and the basic steps. So search for the consistency, open long short position if the synchronization is present, and then search for inconsistency and leave in the market. It's very simple. So here you can see some backtest results. Please note that commissions, spreads, swaps are not taken into account. We only apply any risk. We don't apply any risk management scheme here. All individual properties are ignored in such a way. One pip has always the same weight. These results are simply an illustration of approach efficiency. However, you should process it sufficiently to compose a complete personal trading system. We tested the historical time frame of January 1st, 2005 till April 1st of 2015, 10 years. The average yield is 42% per year, with a maximum drawdown of 22% during all the considered historical data. The renewal rate is 1.9 for 1 year. That's pretty good result for a trend-following system, isn't it? It's psychologically quite comfortable as well, because we have 62% of profitable trades and only 14 trades per year. So we have position holding of 1 month approximately. As you can see, the system demonstrated a nice performance since 2008-2009 financial crisis. 60 trades point here. This effect is typical for trend-following approach, which depends on volatility and magnitude sufficiently. So this system can be used in more efficient way if we enter the volatile market in volatile stage. The demonstrated efficiency provides some hope that this approach can be implemented into portfolio of strategies for position trading. However, it should be processed and combined with risk management rules. We have shown that cross-market analysis based on index implication allows discovering strong, volatile movements. And we have just found how to lead these movements during the completion stage as well. Although the parabolic indicator was used, we don't introduce rigid limitations. You may use convenient trend-following system in combination with a demonstrated approach. Ultimately, the essence of this report was just to show you that a trend-following strategy may be significant if we take the market inefficiency and network effects into account. Okay, thank you very much for your attention.